What if I told you that China, the world's second largest economy, just made a move that could shake global markets? The Chinese central bank has announced it's halting its bond buying program. If you're an investor, this is big news, because government bonds are usually the safest bet. So why would China stop buying them? And what does it mean for the economy? In today's video, we're diving into this critical moment for China's economy. We'll look at how the bond market, the stock market, and even China's currency are all connected in a way that could have major ripple effects on the world stage. This isn't just about China, it's about the future of global finance. Stick with me, because by the end of this video, you'll understand why China might be at a crossroads and how this could impact all of us. Let's break it down. Chinese bonds. Take a look at this chart showing the yield on Chinese government bonds over the last 5 years. Back in November 2020, the yield on these bonds was around 3.94%. But since then, we've seen a steady drop in yields, and now they're down to 1.9%. As we just discussed, there's an inverse relationship here. When bond yields fall, the price of the bond rises. So this means that demand for Chinese bonds has been increasing steadily for the past 4 years, even as China's economy has been struggling. You might find that surprising, because if you've been following the news, you know that China's economy hasn't been in the best shape for a while. So, why are people still buying Chinese bonds? Well, here's the thing. The Chinese bond market is very different from global markets. Access to Chinese government bonds is limited. Bond market breakdown. Let me break this down for you. There are 3 distinct markets for Chinese government bonds. The largest one is the onshore bond market, which is denominated in Chinese Yuan. This market is huge, around $15.5 trillion, and it's primarily made up of Chinese buyers. In fact, the majority of foreign investors can't even access this market. Next, there's the offshore market, which is denominated in US dollars. It's much smaller, at about 600 billion. That's more than 26 times smaller than the onshore market. Finally, there's a third, even smaller market for offshore bonds denominated in Chinese yuan, totaling only around $17 billion. So what does this mean? It means that most of the demand for Chinese government bonds is coming from domestic Chinese financial institutions. These institutions don't have a lot of options for where to invest their money. They can either buy government bonds or invest in the stock market. Let's take a look at what's been going on with China's stock market. Stock market. Here's a chart of the Chinese Composite Index, which includes over 500 of the largest companies in China over the past 5 years. The market peaked in September 2021 at around 3,700 points. Since then, however, it's been a steady decline. There were a few sharp rebounds along the way, each of them driven by government stimulus measures designed to boost the economy and the stock market. But as you can see, these gains have been short-lived, and the long-term trend has been downwards. Now, just last year in September, China announced one of the biggest stimulus packages we've seen in recent times. It gave the stock market a temporary boost. Share prices went up by about 30%, but like the previous rebounds, this didn't last. Right now, the market is on the brink of entering a bear market. A bear market is when stock prices fall by 20% or more, and we're very close to hitting that threshold. So what's happening now is that investors are getting more cautious. If the market officially enters a bear market, we could see even more people selling off their stocks, pushing prices down even further. The yuan. Now let's talk about the Chinese yuan. This chart shows the exchange rate between the US dollar and the Chinese yuan over the past year. As you can see, since the end of September, the value of the yuan has dropped sharply, reaching its lowest point in the last 12 months. Usually, when bond prices rise, it means there's more demand for those bonds. And typically, The currency also appreciates in value. But here, it's the opposite. Why? Well, most of the demand for Chinese bonds is coming from within China itself. This means there's not a lot of international demand for the yuan, which is one of the reasons it's falling. The drop in the yuan's value is also a reflection of the struggles China is facing economically. Summary and conclusion. So what does all of this mean? Why is this such a big deal? Well, the news that the Chinese central bank has stopped buying government bonds is significant. This isn't something that normally happens in a healthy economy. The reason the central bank gave for halting bond purchases is that there's now a shortage of bonds. Why? Because Chinese financial institutions are desperate for safe investments. They don't want to put their money into the stock market, which has been in decline for the past several years. We saw a brief bounce in the stock market recently after the stimulus package, but we've seen this pattern before. Each time the government steps in with stimulus, the stock market rebounds temporarily, and then it falls back down. Right now, we're on the verge of a bear market, and it looks like the downward trend could continue. The situation in China is very different from what's happening in other parts of the world. While global investors are selling bonds and pulling out of markets because of concerns about the global economy, Chinese investors are rushing to buy government bonds as a safe haven. But the problem is, these bonds are in short supply, and that's driving yields to historically low levels. The bottom line is that China's economy is still in a very tough spot. It's slowing down, and there's growing concern about whether China will hit its 5% growth target for 2025. If it doesn't, the stock market could continue to slide. With the upcoming presidential election in the US, where tariffs on China could increase under a potential Donald Trump administration, things could get even worse. So, China is at a crossroads right now. We might be seeing the beginning of a major economic slump as we move into 2025. There's a lot of uncertainty, and this is definitely a situation we'll want to keep an eye on. I hope you found today's video informative and thought-provoking. If you enjoyed it, give it a thumbs up.